With the GDP numbers on top and the PSEI trying to break out of 6,700, can we see a surprise that could be the catalyst for a breakout? For this week, let's also look at some stocks that were down but may not be out for the count in 2024. Let's discuss. My name is Den Slim and welcome to another episode of Monday Market Outlook. Philippine GDP numbers will be on top this Wednesday, and trading economic forecast Q4 GDP to be at 6.1%, which is quite aggressive considering that more conservative estimates put this figure at around 5.4 to 5.6%. However, these figures will still fall short of the government's target of 6 to 7%, because in order to even hit 6% GDP for the full year of 2023, the Q4 numbers will need to be at 7%. So looking at the PSEI charts, we did do a 180 last week, bouncing off of the 6,500 support to end the week right back at 6,680 level. We did mention a possibility of a couple of retests of 6,500 before the market can make a legitimate move towards 6,700. So far, we've seen the market bump its head 1, 2, 3, 4, 5 times at this level. But with the last 2 days where the index has managed to close with these hammer formations, could we be seeing investors positioned to the upside ahead of the GDP announcement this Wednesday? Are we in for a surprise? So we might see the markets consolidate until Wednesday, or does the market make an early move to breach 6,700 and make it to 6,750? The breakout along 6-7 and this trend line resistance here will be critical in setting the tone for the markets in 2024. So we have a couple of scenarios here. We may see the markets hit either this trend line resistance or 6,700 and retrace for a mean reversion into the 20-day EMA and probably consolidate along this area, 6,600 and 6,700. But another scenario here would be for us to break out of this trend line resistance, retest this trend line support, and then consolidate along this upper band here, maybe around 6,900 and 6,750, to give the PSEI some time to digest this new level. Some stocks in focus for this week. JFC is our clear winner. JFC surged past our soft resistance to end the week at 274. But an interesting thought here, JFC has been struggling within this 212 to 260 zone for 2 years now. Could the height of this consolidation be the potential upside for JFC? Because if that is so, then we are looking at a 308 price target for JFC in the coming weeks. So wait for a pullback here to 260, maybe 265, then ride the trend until it bends. We also mentioned GT cap in our previous episodes before, and we mentioned that this looks like a head and shoulders formation, and of course the height of this head and shoulders formation could mean the potential upside for GT cap of around 674 to 680, and look at where GT cap is now. This is the same case for Nvidia. If you look at Nvidia last year, we also saw the same head and shoulders formation, right? We saw the same head and shoulders formation. The height of this head and shoulders formation means that this is the minimum upside for Nvidia, and as hard as it was to believe that this was even possible last year given the bearish backdrop, look at where Nvidia is now. It's at 600. So GT cap is one of those stocks that were down for most of the year but has shown some recent resurgence. GT cap is a fundamentally great stock but has taken a back seat against AC and SM. But last week, the Chamber of Automotive Manufacturers of the Philippines announced that a total of 429,800 vehicles were sold last year, with Toyota leading the pack with 200,000 units sold. A far second is Mitsubishi with 78,000. And they project 2024 to improve this number to 500,000. So there are certain stocks, yes, last year that have seen some steep sell-offs that may show some promise this year. A quick look at the banking sectors show a slowdown of net interest margins for the top 3 banks, especially on the heels of future rate cuts, which most likely will be in the second half of 2024. Now, we will see these margins start to go down. And I did mention that a rotation out of the banking sector may be the way to go for 2024. But, lo and behold, the top 3 banks have come roaring back the past few weeks. BDO breaching 135 and 143 resistance to consolidate along this area. BPI hitting 113 critical zone, breaking out of this downtrend line, and Metrobank breaking out of this trend line resistance and defending the 57.25 support. So it seems like the banking sector is telling the market, guys, don't count us out yet. If we think about it, while rates will go down, net interest margins will probably go down, but against the backdrop of rising vehicle sales, are they going to be translated into car loans? And with rates going down, could this mean that loan availment growth could offset the reduction of net interest margins? We'll see. So let's look at some stocks that have been the key drivers for the PSEI in the past year. So we have JGS, we have Monde, we have Ayala Land, SMPH, URC, SM, BPI, AEV, AC, and TEL. With the recent overhang on the AC stock, could SM be the better choice for 2024? Because, first, SMPH is the third largest condo developer in the country, right? Its small business is also doing well and will probably benefit from the REIT IPO planned for next year. And while the SM REIT may have some effects on SMPH, it could bode well for the SM stock itself. SM Retail is an underrated profitability driver for SM. And last year, we saw margins significantly improve across the 3 different retail segments. And they have higher margins compared to their peers. And the retail segment accounts for 18% of SM's net income. And currently, SM is around 1.8 standard deviation below its 10-year PE average and is even 16% down from its pandemic highs last November of 2020. So with forward EPS going up and SM at historically very cheap levels, could SM be the better bet for 2024, right? So going back to the list, we also have Monde here. What about Monde? Monde disclosed their preliminary fourth quarter and 2023 full year 2023 results. The company has so far surpassed expectations with their Q3 numbers. So there's reason to believe that they will do the same for Q4. Now, could this be the year that Monde bounces back? Because Monde's stock price has been beaten and battered since its IPO, dropping to a low of 6.19 before bouncing back to 8.43. Stocks could actually drop by as much as 70 to 80% before it sees a bottom. Have we seen the bottom for Monde here? Remember that Monde is a consumer powerhouse with their Lucky Me brand. Lucky Me continues to dominate the noodle segment and has continued to increase their market share. Now, if rice prices goes out of control due to El Nino, I remember that instant noodles are the second staple for Filipino families. So despite the drag in their corn business, margins are said to have been maintained despite rising input cost. And Monde's second half growth shows that they may be back to their usual profitability just in Q4 alone. No? So yes, Monde may also be saying, don't count us out yet. Finally, it's almost Chinese New Year. Let's talk about China. This sector is the most beaten and battered market in recent years. While it looks like there may not be a bottom in sight, this is a sector that could wake up anytime soon. The Hang Seng Index up 10% last week off of China's stimulus, and we're starting to see trades coming in with increased volumes. No? The index here consolidating across this demand zone. We could see the Hang Seng Index retrace and potentially rally into the 17,200 demand zone here. Alibaba down 79%. No signs of reversal yet, but could this be a double bottom? Tencent here down 65%. So far, price action coiling along this price channel, but it hasn't hit a new low. So Tencent showing much more resilience. So if China does rebound, I think Tencent would be the one to lead the way. But could China grow despite their negative GDP growth? No, yes, we've seen China in the 1990s here, negative GDP growth. The Shanghai Composite Index went up 93 points. Negative GDP growth here, China went up. Now we're seeing the same negative GDP growth here. Could we be setting up for a rebound soon? And last December, China was downgraded by Moody's from stable to negative, citing slow economic growth and the property crisis. But look at what happens every time China gets downgraded. We have here 89, downgrade, and what happens here? 92, downgrade, what happens here? We have here 98, downgrade, what happens here? It marked the bottom, right? What happened here in 2017? Downgrade, the markets went up. So we got a downgrade in December. Could the China market be setting up for a rebound this year? So maybe don't count China out yet. Last week, US GDP numbers came in at 3.3%, defying expectations of 2%. This puts the US economy at 2.5% growth rate for all of 2023. Now, core personal consumption expenditures was cooler than the expected 3% estimate, clocking in at 2.9% for December. Now, this is the first time that this gauge fell below 3% since March of 2021. And what's even more encouraging here is that the core PCE inflation rate on a 6-month basis was 1.9 for the second month in a row, which is well below the Fed's target of 2%. So let's digest both data points. First, you have an economy that's growing by 2.5%. And at the same time, inflation has gone down to target levels. So here we are again. It's the same soft landing scenario. But despite that, the S&P 500 broke its 6-day winning streak, ending Friday's session a bit lower by 4 points, but not before hitting another all-time high at 4,910. While the US markets continue to struggle along this 4,900 zone, let's look at how the markets may play out for the next week. If we look at market breadth, see the percentage of stocks above their moving averages go down despite the S&P 500 going up. So we are continuing to see only a handful of stocks driving the market. But as we start to see an uptick here on the percentage of stocks going above the 5-day, 20-day, and the 50-day moving averages, we may see rotation, and this could start pushing the markets to new high in the next coming weeks. This week, blockbuster earnings are on top for the handful of stocks that are keeping the markets up. Looking at the lineup here, we have Alphabet, AMD, and Microsoft on Tuesday, Qualcomm on Wednesday, along with MasterCard, and of course Novo Nordisk, Ozempic, Amazon, Meta on Thursday. But with forward PEs at the 19 to 20 levels, the S&P 500 isn't exactly cheap. Could these stocks go any higher? While we've been caught up with the AI hype, we also have to look into some fundamental reasons why tech stocks just keeps going up. Time and again, these companies continue to show robust earnings growth. And if we look at this chart here, the tech sector has really enjoyed very high margins compared to other sectors, and forward margin estimates continue to climb. Combine that with expectations of rate cuts ahead, and you've got investors currently willing to pay for high quality earnings growth. So for this week, local PPI numbers and JOLTS numbers coming in on Tuesday, but then it's our turn to clock in GDP results for 2023. The Fed is expected to keep rates steady on Wednesday. Let's see what J. Powell has to say about the latest economic numbers, employment data coming out at the end of the week. So with all of this happening, it looks like the S&P 500 could be setting up to hit 4,950, but we also have to anticipate a possible mean reversion in the following weeks as we've been a bit too extended off of the 20-day moving averages. Now, while we are celebrating the markets, we also have to be fearful, especially when the markets have become extremely greedy. The fear and greed index has been hovering around greed and extreme greed for quite some time now. So let's look at some potential global risk coming into 2024. Of course, the El Nino phenomenon is the most immediate concern, followed by AI, right? So after the hype, the next level of discussion for AI would be the kind of misinformation or disinformation this could generate, especially after the outrage on AI-generated images of Taylor Swift spreading across social media. Political polarization is at number 3 as billions of people head to the polls this year. The threat of fake news spreading across social media would be a big concern during elections. Cost of living will affect consumer spending power. Cybersecurity will always be a concern. Economic downturn could be a possibility for 2024 as all indicators still points to a recession despite the soft landing narrative of the Fed. Of course, with the US elections, they will downplay any recession talks and paint a good picture for the elections. Supply chain issues as well as the potential for armed conflict may also rear its ugly head for the rest of the year. So we'll see. But that's it for this week. If you found the information useful, please like this video, subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week.